Hello there. Welcome to the fourth session in this course on financial accounting. In this session, we'll be covering accounting for revenue and receivables. So far, we've been looking at everything through a generic lens. We've been looking at the accounting cycle and also how to make end of period adjustments. From this session on, we're going to be focusing on the most important accounts in a bit more detail. We might also sometimes look at a few accounts together in ways that they make sense. So let's get started. In this session, we're going to be looking at accounting for sales revenue, Particularly, we're going to be looking at how to deal with credit card discounts, how to make journal entries when we have to pay credit card discounts, and also when we encounter sales discounts or sales returns. Eventually, we're going to be looking at how to account for bad debt. Whenever we make sales on credit, it is possible that sometimes some customers may not pay us, So we look at how to deal for that from an accounting perspective. Okay, so how is sales revenue actually reported in your income statement? Credit card discounts and sales discounts and all kind of sales returns and allowances are deducted from the revenue, and eventually only the net revenue that has been earned is reported in the income statement. So you might ask me why these discounts are not categorized as expenses, for example, right? The net revenue after making all these deductions shows a snapshot of what you actually sold to the customers. Hence, it makes sense to deduct all these in your revenue part rather than showing them as expenses. Okay, let's get started with how to do journal entries when you have to deal with a credit card discount. Let's look at that using an example. On the 4th of January, Joe sells 20 bottles for $10 each. The customer pays with credit card, and the credit card company, it charges a fee of 3% on every transaction. So when Joe sells 20 bottles for $10 each, he earns a revenue of $200. So revenue has to be credited for $200. So how much is the cash that is actually collected by Joe? Because the customer pays with his credit card, during the transaction, the credit card firm charges 3%, right? So 3% on the $200 transaction is $6. So the credit card firm takes away $6. So Joe receives a cash of only the rest, which is $194. So you debit the cash account, which is an asset, by $194. So what happens to the $6 that is charged by the credit card firm? It's being recorded as a contra revenue. We're going to call this account credit card discounts, which is a contra revenue account. What do I mean by a contra revenue account? It's an account that sits under revenues but reduces your revenue. Hence the X in front of R, to denote contra revenue. Credit card discounts is a contra revenue account, and hence it behaves the exact opposite of revenue when you do your journal entries. So when you have to book a contra revenue, you have to debit that account. So you debit this contra revenue account by $6, which brings down the overall revenue by $6, and in turn, the stockholders' equity goes down by $6. Next, let's look at how to deal with sales discounts that are offered to businesses. We'll look at how to make journal entries in the case of sales discounts very soon. But first, I would like to introduce you to a notation that is very commonly used between businesses. This notation shows how much of a discount a customer can claim by making payments early. For example, look at this particular notation, which can be read as 2, 10 and net 30. What does that refer to? If the customer pays within the first 10 days of receiving the invoice, the customer gets a 2% discount on the overall billable amount. But if the customer pays beyond that 10 days, then he has up to 30 days to pay that invoice. In that case, he would be paying the whole billable amount. So the notation is just a shorthand way of referring to everything we've just discussed. Now let's look at the journal entry in the case of when a sales discount is being used by the customer. On the 5th of January, Joe sells 30 bottles for $10 each with terms of 2, 10 and net 30. The customer pays on the 13th of January. On the 5th of January, when Joe sells 30 bottles, he earns a revenue of $300. So on the 5th of January, you would credit your sales revenue account by $300. Because the customer is yet to pay, he would debit his accounts receivable account by the same $300. So accounts receivable, which is an asset, would be debited by $300. Because the customer pays on the 13th of January, it falls within the first 10 days. Okay. So if the customer had paid within the first 10 days, he would get a discount of 2% on the whole $300. Okay. 2% of $300 is $6. Okay. So the customer would pay only $294 because he's paying on the 13th of January. Okay, so Joe collects cash of $294 and hence cash is being debited by $294. And the $6 which is given as a sales discount should be recorded as a contra revenue account. Okay, sales discount is a contra revenue account. Okay, that is going to be debited $6. When you earn revenue, you credit that account. So when you have a contra revenue, you would debit that account. Finally, you have to reverse your accounts receivable transaction. Okay. Hence, you would credit the accounts receivable account by the $300 to show that you no longer have a receivable. So this is the journal entry you would make on the 13th of January. If the customer had paid outside of those first 10 days, then the journal entry is quite straightforward. Okay. When he finally pays, cash collected would be shown as $300. So cash would be debited $300 and accounts receivable would be credited $300. From a customer's perspective, when you look at such discount terms, should you take that discount? How do you come to the decision whether to take that discount or not? Okay. For a $100 purchase, a customer saves $2. Okay. So that's the 2%, right? By paying on the 10th day instead of paying on the 30th day. Okay. So for that extra 20 days, okay, the customer pays an additional $2 on every $98 he pays. Okay. So if he had paid in the first 10 days, the customer would have paid only $98. But because he's paying on the 30th day, he would have to pay that extra $2. We've assumed here that the customer would choose to pay on the 10th day or on the 30th day rather than on any other days. Because by holding on to that cash as long as you can until you really have to pay, okay, you can earn interest on that cash which is sitting in your bank account. So the comparison boils down to whether you make the payment on the 10th day or on the 30th day. So the interest rate you pay for that additional 20 days, okay, is that you're paying that extra $2 for every $98 you pay. So you're paying an interest rate of 2.04% for that additional 20 days. So if 2.04% is the interest rate for 20 days, then the annual interest rate is 365 days divided by 20 days multiplied by 2.04% is 37.23%. That's a very high annual interest rate. Usually when you borrow money from a bank, you could get it for way cheaper than 37%, right? Let's say you could borrow money for 5% or 10% from a bank, okay, which is way less than 37.23%. So for the customer, it definitely makes sense to take the discount and pay within the first 10 days. But then why would any seller offer you such payment terms with huge discounts? Because when a producer or seller is able to collect cash quickly, he can fund the next production process using that, and this can speed up the overall production cycle. So the seller doesn't have to wait these extra days to collect cash from the customer in order to fund the next cycle in their production process. Next, let's look at how to deal with sales returns. A customer might return goods for a variety of reasons. One, the goods might be damaged either before sending or in transit. Okay, so the customer cannot really use it, so he would return it. Okay. Or the customer could simply return the goods because it didn't meet his expectations, right? Okay. Maybe he just didn't like any of the characteristics of the product, or maybe he ordered too much for whatever reason, he could return it. Okay. If the goods were damaged, you cannot resell it. Okay. But on the other hand, if the goods were returned for any other reasons, okay, you could put it back in your inventory and sell it again to other customers. So we'll look at how to make journal entries in either of these cases. Okay. For this, let's use an example. Okay. On the 7th of January, Joe sells 50 bottles for $10 each. Okay. On the 10th of January, the customer returns 8 bottles because they were damaged. On the 12th of January, the customer returns a further 12 bottles because he realized he had ordered in excess of his requirements. Okay. So these 12 bottles can be resold because they're not damaged, right? Okay. Joe had paid $7 per bottle initially with the intention of reselling them. So that's the cost he paid to procure each bottle. Okay. The customer pays his dues on the 15th of January. Okay. Let's look at the journal entry for each day. Okay. On the 7th of January, because Joe sells 50 bottles for $10 each, he makes a revenue of $500. Okay, so revenue is being credited by $500. Okay, because he sells on credit and the customer hasn't paid yet. Okay, he would debit his accounts receivable account by $500. Okay, the cost of procuring each bottle was $7, right? So 7 times 50 is $350. Okay, so Joe has to credit his inventory by $350. Okay, so he has to remove those 50 bottles from the inventory. Okay, and he has to transfer it to cost of goods sold. Okay, cost of goods sold is an expense and hence that would be debited. Okay, so you debit cost of goods sold by $350 and you credit your inventory account by $350. Okay, then on the 10th of January, okay, the customer returns 8 bottles because they were damaged. So for this, we're going to debit a contra revenue account. We did the same in the case of credit card discounts or sales discounts. Okay, in this case, we're going to call the account sales returns and allowances. Okay, and we're going to debit this contra revenue account, which brings down the total revenue by $80. Okay, we're also going to credit the accounts receivable account to show that this is no longer receivable, right? Okay, you cannot expect the customer to pay this $80 later on. Okay, so we're going to credit the accounts receivable account by $80 on the 10th of January. Then on the 12th of January, okay, the customer returns another 12 bottles. Okay, but this is because he had ordered in excess. Okay, so these 12 bottles can be resold. Okay, so on the 12th of January, okay, you're going to do the same as before. Okay, you're going to debit your sales returns and allowances account, okay, for $120, and you're going to credit your accounts receivable account by $120. Okay, but in addition to that, you're also going to put back these 12 bottles in your inventory. Okay, so you're going to debit your inventory account by $84. Okay, 12 times 7 is 84. Okay, and you're going to credit your cost of goods sold account by that $84. Okay, so you're removing it from your cost of goods sold and putting it back in your inventory. In the previous case where the bottles were damaged, we did not remove it from the cost of goods sold account. Okay, so the damaged bottles will still continue to be part of cost of goods sold, but would not earn any revenue in return. Okay, that's the cost Joe has to live with because his bottles were damaged. Okay, then finally on the 15th of January, when the customer pays the dues, okay, cash is being debited by $300 and accounts receivable is being credited by $300. Okay, initially the customer owed $500. Okay, but because later 8 bottles and 12 bottles, so a total of 20 bottles were returned. Okay, so now the customer has to pay you just for 30 bottles. Okay, so cash is debited for $300 and accounts receivable is credited by $300. Last but not the least, we look at how to account for bad debt. Okay, whenever you sell to a customer on credit, you always assume a risk that the customer may not pay you. So let's say in the first time period, you sell a certain amount of goods on credit. Okay, so what would you do as part of your journal entry? You would credit your sales revenue and you would debit your accounts receivable. But if you know that the accounts receivable you've stated as per your journal entry is not really feasible, okay, then you might want to reduce that accounts receivable to show what is practically achievable, so that you're conservative and you don't overstate your assets. Okay, you don't want to overstate your accounts receivable. And you can't simply wait for your customers to not pay and then write it off as bad debt. What you have to do is to be proactive and specify what you think is going to be your accounts receivable. You're expected to make an estimation of what amount of this accounts receivable is not collectible and already deduct that from your accounts receivable in the same time period. By doing this, you're in line with the matching principle because now your bad debt is matched with the revenue that has been earned in the same time period. And you're not waiting for the bad debt to be written off in a different time period. Now that you've already estimated bad debt in the current time period and made the appropriate journal entries, in the future, whenever your customers do not pay, you can write them off as bad debt as and when they happen. We'll look at this in a lot more detail by using an example and showing how to do the journal entries. Okay. On the 27th of December, Joe sells a bottle each for $10 to 20 different customers on credit. From past experiences, he believes that it is uncertain that he'll be able to collect the money from 5 of those customers. Okay. On the 10th of January, the following year, he realizes that he certainly won't be able to collect the money from 3 of those customers. On the 21st of January, one of the customers who Joe had earlier assumed that would never pay, pays for his bottle. Let's consider each of these days in isolation and look at how to perform the journal entries. First, on the 27th of December, Joe sells a bottle each for $10 to 20 customers. So Joe earns a revenue of $200, so you would credit your revenue account by $200, okay? And you would debit your accounts receivable of $200 because cash hasn't been paid yet. So let's look at how that looks on the financial statements, okay? On the 27th of December, okay, if you look at the balance sheet, it would show an accounts receivable of $200 under assets, okay? And on the income statement, Joe would show a sales revenue of $200 for the 20 bottles, okay? He would also show the corresponding cost of goods sold for the 20 bottles. But I haven't shown that here because we've already seen how to do that, right? You would debit your cost of goods sold and you would credit your inventory. Okay, from past experiences, he believes that it's uncertain he'll be able to collect the money from 5 of those customers. Okay, so Joe believes that he won't be able to collect $50 out of the whole $200. Okay, if on the 31st of December, if Joe is preparing his financial statements at the end of the year, by showing his accounts receivable as $200, he would be overstating his assets. And by stating that his sales revenue is $200, he would also be overstating his revenue. Hence, on the 31st of December, Joe would have to make an adjusting entry before preparing his financial statements to show that realistically he expects to collect only $150. On the 31st of December, Joe would record the following journal entry. First, he would credit a contra asset account called Allowance for doubtful accounts. Okay, he believes that it is uncertain that he'll be able to collect $50. So for that, he creates an allowance account, okay, which shows that the accounts receivable has to be deducted by 50. So what is the purpose of creating this contra asset account instead of directly deducting it from the accounts receivable account? He cannot deduct $50 from the accounts receivable account yet, okay, because this is just an approximation, right? He estimates that $50 may be uncollectible. Okay, so we're going to use the temporary account, okay, which is a contra asset account, okay. Allowance for doubtful accounts, which is a contra asset account, okay. If you credit that by $50, this $50 is deducted from the $200 and the balance of $150 is shown as a net realizable accounts receivable, and this balance is shown under assets in the balance sheet. Okay, so crediting the allowance account takes care of assets, okay. Assets are not overstated anymore. On the other hand, revenues and profits are still overstated, right? Hence, we debit a bad debt expense account, which is an expense which brings down stockholders' equity, okay? By debiting that account by $50, okay, we don't overstate the profits in the income statement, okay? So now if we look at the balance sheet and the income statement, okay, under balance sheet, the allowance for doubtful accounts, as we said, is a contra asset account. It sits under accounts receivable and deducts the net realizable accounts receivable. Okay, now the accounts receivable is only $150 as shown in the balance sheet. And under the income statement, okay, now you have an expense called the bad debt expense for $50, which brings down the net income. So this $50 is just an estimation. Okay, Joe estimated that 5 of the customers may not be able to pay. Okay, but on the 10th of January, the following year, he realizes that he'll never be able to recover the money from 3 of the customers. Okay, so 3 of the customers, for whatever reason, he realizes may not be able to pay him. So whatever was an estimation in the previous step is becoming a reality now. So now the reality is that 3 of the customers will definitely not be able to pay him, and he realizes that on the 10th of January. Okay, so how do we write off something that is definitely uncollectible? In the previous step, when we had an estimation, okay, we created this allowance account to take care of that estimation. Okay, now we know for sure that 3 of the customers may not be able to pay us. Okay, 3 customers, which is $30. Okay, so now we remove that $30 from the estimated allowance account and we directly remove it from the accounts receivable. Okay, so you would debit the allowance account for $30, okay, and you would credit the accounts receivable account by $30. Okay, I would like you to pay attention to the accounts that are affected here. Okay, accounts receivable goes down, allowance goes down. Okay, both are under assets. One is an asset, one is a contra asset. Okay, so the net realizable accounts receivable is unchanged. So the overall effect on assets in the balance sheet is unchanged. And writing off an uncollectible does not affect the income statement either. So if we look at the financial statements under balance sheet, okay, $30 is removed from accounts receivable and $30 is removed from the allowance account. And the net accounts receivable is still the same, $150. And no changes happen in the income statement. So whenever you write off uncollectibles, okay, finally it has no impact on the total assets on the balance sheet or no impact on the income statement either. On the 21st of January, one of the customers who Joe had earlier assumed that would never pay, pays for his bottle. Okay, now we'll look at how to make a journal entry to reverse a write-off. Okay, this customer had already been written off in the previous step. Okay, now we're going to look at how to make the journal entries to reverse this write-off. The first step in reversing this write-off to actually reverse the journal entry you made in the previous step. In the previous step, you debited your allowance account and you credited your accounts receivable account. Okay, you're going to reverse that. So you're going to debit your accounts receivable by $10 and you're going to credit your allowance account by $10. Okay, because it's just one customer, right? Hence you do it for just $10. Okay, once that step is completed, you've shown that this $10 is back in the accounts receivable account. It is back to being shown as money being owed to you. Okay, in the next step, because this customer pays, cash is debited and accounts receivable is credited. This journal entry step is similar to what you would do anytime a customer pays you, right? Now let's look at the financial statements. Okay, in the first step, you would have increased your accounts receivable by 10, so 170 would have become 180, and the allowance from 20 would have become 30, right? Okay, you see in the previous step it was 170 and 20. Okay, that would have become 180 and 30. Okay, but in the second step, the customer pays you cash, so your cash increases by 10, and that 10 is deducted from your receivables. Okay, so you can see that overall your assets would be 10 plus the 140, it would still be 150. On the income statement, no changes at all, right? Okay, anytime you write off or reverse a write-off, okay, there is no change in the income statement. Okay, so in this example, okay, Joe estimated that 5 of his customers out of the 20 customers will not be able to pay him. How did he come up with that estimate? We're going to look at two methods on how to estimate bad debt. Okay, the first method is called percentage of sales method. Okay, that's quite straightforward. Whatever credit sales you make, a percent of that you estimate to be uncollectible all the time. So how do you estimate this percentage? You look at your past experiences, right? You look at any kind of trends that can give you a clue in estimating this percentage. Okay, the second method is known as the aging of accounts receivable method. In this method, you classify all your accounts receivable based on how much time has passed since the invoices were due. Based on this categorization and an estimation of what percentage of receivable is deemed uncollectible in each of those categories, okay, you look at the overall aging schedule and you estimate the total bad debt. Let's first look at the percentage of sales method using an example. Joe had credit sales of $2,000 during the current year. From past experiences, he realizes that bad debts are usually 3% of the total credit sales. Prepare the adjusting journal entry for the end of the year. Okay, so $2,000 of credit sales, usually 3% is uncollectible. Okay, 3% of $2,000 is $60. Okay, so Joe would make a journal entry where he credits an allowance of doubtful accounts for $60. Okay, that's a contra asset. Okay, and he would debit the bad debt expense for $60. Okay, we've seen how to make this journal entry already. Okay, in this example, we're just learning how to use the percentage of sales method to estimate this bad debt. Now let's look at an example for the aging of accounts receivable method. Okay, Joe uses the aging approach to estimate his bad debt expense. Okay, the balance of each account receivable is aged on the basis of 4 time periods and is shown in the table below. Experience has shown for each age group, the average uncollectible rate on the amounts receivable at year end is as shown in the table below. Okay, on the 31st of December, end of current year, the allowance for doubtful accounts balance is $300. It's a credit balance, okay, before the adjusting entry is made. Prepare the adjusting entry for the end of the year. Okay, let's look at what's shown in the table. Okay, so there are 4 time periods based on which the balance of each accounts receivable is classified. So 60,000 of accounts receivable is not yet due. Okay, what does that mean? The customer still has time to pay that money. Okay, and for $40,000, the customers are past due. Okay, but they are within 30 days beyond which they had to pay. And this $25,000 is past due by 30 to 90 days. Okay, and another $10,000 of receivable is past due by more than 90 days. Okay, which means more than 90 days have passed since the customer owed us that money. Okay, on the table, okay, Joe also shows the average uncollectible rate on the amounts of receivable, okay, as per the age group. So for money typically that is not yet due, Joe estimates that 2% of that is uncollectible. But for money that is past due but still less than 30 days, okay, Joe estimates 5% is uncollectible. For money that is 30 to 90 days past due, he estimates 10% is uncollectible on average, okay. And for receivables that are past due by greater than 90 days, okay, he estimates 30% is uncollectible. You can already see that this follows a pattern, right? The more time has passed since it's due, the less likely you'll be able to collect it. Hence, the estimated percentage of uncollectible keeps increasing the more time has passed since it's due. Okay, first let's calculate how much do you estimate to be uncollectible in each of those categories. Okay, for receivables that are not yet due, okay, the total receivables is $60,000, out of which Joe thinks 2% is uncollectible. Okay, so 2% of 60,000, he estimates he'll not be able to collect $1,200. Okay, in the next category for 40,000, he estimates 5% is uncollectible. Okay, so that's $2,000. 5% of 40,000 is $2,000. In the next category, 10% of 25,000 is $2,500. Okay, and 30% of $10,000 is $3,000. So in total, he estimates $8,700 to be uncollectible. So normally he would make a journal entry to show this $8,700. So he would debit his bad debt expense account by $8,700 and he would credit his allowance for doubtful accounts account by $8,700. But in this case, we've been provided some additional information. On the 31st of December, the allowance for doubtful accounts balance is $300. Okay, so the allowance account has a $300 credit balance before the adjusting entry is made. So when would you have a credit balance for your allowance for doubtful accounts account? If you had overestimated your bad debt in your previous period, okay, then you would be left with a credit balance. Okay, so your allowance account still has a balance of $300, which is an estimate. Okay, your new estimate should be $8,700. Okay, so your allowance account should reflect this new balance. Okay, because you already have a $300 balance in your allowance account. Okay, by crediting just $8,400, okay, you would reach that balance of $8,700. So the account already has $300 in there. By crediting another $8,400, the total credit balance becomes $8,700. On the other hand, what if you had underestimated your allowance in the previous time period? Okay, in that case, you would have had a debit balance to start with. So if you start with a debit balance, okay, the journal entry you make should clear that debit balance, and on top of that should make sure that you end with a credit balance of $8,700. Okay, so let's say if you had a debit balance of $200, okay, then you need to clear that $200 and then you still have to finish with a credit balance of $8,700. Okay, so your journal entry would have been made for $8,900, which takes care of the $200 plus the $8,700 which is required. Estimations are not always perfect, right? Companies look at trends and they learn from their past estimations. Okay, they can always make corrections in the forthcoming years, right? Okay, so regardless of whether the allowance account was left with a credit or a debit balance, now we know what journal entry has to be made in order to finish with a desirable balance. This concludes our session on accounting for revenues and receivables. Okay, in the next session, we'll be looking at accounting for cost of goods sold and inventory. Thank you for watching. Cheers.